Hi, it's Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. It is Friday morning, January 29th, 2026, and we are delighted to bring you an update of the week post-Davos and look at some of the digestion of some of the news flow that went on in the aftermath of some geopolitical firsts at Davos. We're also going to talk about the Fed decision, and we're going to talk about the dollar movement and how some of the outlook for the rest of the year will be affected by not only the new Fed chairman, but by some of the overtures made with respect to tech stocks in the week ahead. So let's bring up the slides and kick off. I've called today's podcast YoYos and YOLO, as we know that President Trump has already said that he would like to be able to affect the dollar and have it move up and down like a yo-yo. This certainly is an interesting analogy for the US dollar, as we know that there have been some ways that the dollar has been affected intentionally and some unintended effects of some of the policy around that, in terms of confidence in the US, confidence in the monetary and fiscal policy of the country. So we'll analyze that a little. And then YOLO is the famous you only live once, which when we're looking at some of the tech stocks and some of the existential questions, as well as the fear of FOMO, missing out on that tech trajectory, there has been some interesting movement when it comes to tech stocks this week. As usual, we'll speak about inflation, interest rates, equity markets, geopolitics, and other asset classes. And we are going to be looking in terms of some of the subcurrents this week. The Fed has suggested that the economy is on a firm footing. We will be looking at some metrics that question whether we're at peak tech adoption, and there are other reasons for fears in markets based on some upcoming policy changes. As always, we cannot get away from analyzing precious metals, and we will be looking in particular at gold's real and virtual divide. Virtual gold, of course, being akin to Bitcoin, digital assets. Real gold, the real thing, but silver has also been on that bandwagon. We will look at the picks and shovel trades around AI, as we've been focused on the infrastructure and parts component, the data centers, the provision of infrastructure to this for some time as an acceptable adjacent trade. We'll look at how that's doing, and as always, we will speak about portfolio implications. So starting with inflation, the saga winds on. We have had some mixed messaging from the Fed, on the one hand suggesting that they were confident in the employment picture, but also had a nagging concern about inflation. This was interpreted as a somewhat hawkish stance by Chairman Powell in one of his last press conferences of his tenure. So looking at what's going on with inflation, if we look at the US electricity prices, they, as we've spoken about before, have been jumping higher than broader inflation. US electricity up 6.7%. in terms of that CPI, with inflation, mainstream CPI, well, comfortably below 3% at 2.7%. When we've heard that on the job side, I mentioned that the Fed had been looking at the jobs picture, getting some confidence, that we're looking at this disconnect between plentiful jobs and jobs being hard to find. Those lines are now starting to meet. We've certainly got away from the large gap that was in place post-COVID, and plentiful jobs, the perception of that has now come close to 20%, and the perception of jobs being hard to find is now close to the same number. So again, a bit of a mixed picture in the employment market according to your point of view and where you sit on that earnings spectrum. Moving then to rates, obviously this economic vibe feeds into the rate decision. The rates were left unchanged by Chairman Powell this past week, and it was really a press conference which was suggesting it was more of the same. There was not a desire to create ripples or to really create a reaction or really to leave anything sensational or remarkable at all. And the Fed chairman did seem like he was keen to wind it up. He had urged his successor to stay out of elected politics. Let's not forget, it was only a few weeks ago that the chairman himself made a video in response to a criminal investigation against him. He has not been afraid to take a stand. And it does suggest now, as we look at just the breaking news of who may be appointed as the next Fed chair, we will see that this may well be something that is actually likely to occur. But let's go back initially to the jobs report, because there were some interesting charts that came across our desk this week that will be interesting just in terms of the flattening of that picture. So when we have the moving average of employees who've been notified of layoffs, that's the top left-hand side, you can see that did spike in the middle of last year. It fell somewhat, has ticked up again, as ticking down. It seems to be hovering around a higher base rate than it was in 2021, 2022. We're still looking at a reasonable number of employees getting layoff claims. Initial claims for unemployment have been consistently flat since about 2022. Some movement in there, but not a big movement in the unemployment picture. I think we know that. This, of course, could be distorted by the large number of gig jobs and the fact that there is not always a direct flow through from layoffs into the unemployment claims immediately. So a bit of a transmission effect, but encouraging to see that that number remains so low compared to where it was during COVID. And when we look at the employment in the tech industry, and there has been a lot of focus on this week, because we've looked at the number of employees, say, employed at Google, at Amazon, and that number seems to be flat to slightly lower, despite the fact that the revenues of these companies, their capacity is significantly higher. This points to the replacement of many laborers with robots and just the efficiency drives and less roles needed. This chart showing the employment in selected tech industries, quite flat, not trending down, but not moving up either, but despite moving up somewhat significantly between 2020 and 22. So a flattening there. This is the issue. The fact that the productivity is coming without a commensurate rise in jobs. This is the issue, that can that productivity gain continue, and what will that mean for jobs? Before moving back to the equity market sectors and looking at some of the drivers there, it is worth making a note on the breaking news around who the likely successor to Chairman Powell is. Three people close to the administration have apparently suggested it is going to be Kevin Warsh, who would be considered a more orthodox choice for Fed chair. He has made his views clear in terms of his desire to see a reduction in the Fed balance sheet. That seems to be something that is shared by Scott Bessent, Secretary of the Treasury. It's also suggested that he has not been afraid to be hawkish in the past, and that he, with significant Fed experience, is likely to be more of an independent voice and not an obvious candidate to channel government preferences. So this has actually been received well in the market, but in the sense that the dollar has strengthened, the equity market has fallen slightly as there is an expectation of fewer rate cuts. We already had a flat rate decision at the last meeting. The estimate we hold at Moneta is still for 2 to 3 cuts this year, but that may well depend on the personalities who appear in the next decision-making forum, and we will be watching that very closely. But I'd say markets are somewhat reassured that the pick has been seen as a somewhat more orthodox pick, so that there can be stability and essentially some certainty in terms of likely Fed policy making going forward. Moving to some of the sectors, and tech in particular, and how that's likely to drive equity markets. So a few indications, and we've seen this before in terms of saturation of tech demand. And if we look at average time spent on TikTok per day, this seems to be ticking downwards. We've seen that 2023 seemed to be a peak there, 24, 25 ticking downwards, and hovering at 60 minutes a day in 2027. So this, for those of us with young children or teens, would seem to be a positive indicator. There is a saturation point. There could, of course, be a switch to other forms of social media, other forms of technology. But certainly in terms of the growth of this segment of the population, it's not growing, and their use seems to be stabilizing. And then if we look equally at Apple shares, they have had their longest weekly losing streak since 1993. So consecutive weekly declines, 8 consecutive weekly declines we've seen in Apple shares. So again, a suggestion of saturation. We know that there have been question marks about Apple's ability to grasp the AI trend and properly leverage that. And that has therefore been recognized in their shares. So again, more of a mixed picture emerging in tech. Investors getting into the detail, looking at where the demand and revenue trajectories are likely to go. And that is, I think, a very healthy development as we move into 26 and look at the diversion within that sector. Some of the other sectors, we'd asked about what about the picks and shovels and what's going on in terms of the data centers and the play on utilities. We have a lot of interesting slides this week in terms of data center demand, as well as electricity demand, and how some of those stocks have been performing. So just to start with, in terms of electricity demand, I think we know that there is a surging electricity demand, and that one of the factors that will have to supply that is green energy. We've spoken before about how well green energy actually did in 2025, even as the oil price was falling. We know that there will not be able to meet the demand for electricity simply from fossil fuels and traditional sources alone. And the interesting chart on the bottom left, solar had met 61% of US electricity demand growth in 2025. So this is the growth. This is not the overall demand, but this is a very sort of solid reflection of the ability of solar to reflect that. And we know that Elon Musk has seen that. He has solar farms in place around his plants in Texas, and that this is a sign that there is simple, and as well as the solar cells being placed in residences around the US. This is a sign that this is simply we cannot avoid the use of this as a source of electricity. Grid tech is a term coined by Bloomberg, and has suggested that this is emerging as a credible AI exposure amid power constraints. Grid tech and the performance of that in terms of the gray line here on the left, it has been performing nicely, certainly exceeding the GSI World Energy Index. That has been anything that is really replenishing some of the underinvestment that has been made in the grid. But if we do look at utilities, on the other hand, and this is the right chart, we can see that utilities broadly have generally not performed that well when it comes to looking both at the Virtus Reeves Utilities ETF, the S&P 500 Utilities Index. One is that the ETF has outperformed the index, but overall, over the course of the year, it has not performed particularly well compared to some of those AI names. So maybe a latency in picking up the demand for this utility sector, but equally a sign that perhaps there is some concern around the demand for those data centers. And if we look then to some of the data center numbers here, just switching to the end of the presentation, but in terms of the new power law, we know that power demand from AI centers is expected to quadruple in 10 years. But if we look at where the data center growth is going, the data center growth is growing. Last week, we showed how there have been, however, a higher number of cancellations, although in relative terms, still growing, but that the power, which is the gray line here, that the power production has been stalling. So still a big gap when it comes to data center demand and power demand. Moving on to other sectors affecting equity markets. So we do also know that health insurers have been in the crosshairs with some of the recent overtures around healthcare reform. The president has expressed a desire to put the subsidies back to the individuals, the consumers, and not allow that, not necessarily pass that through to insurance companies, to let the individuals decide, essentially. That has had a negative effect on health insurers. This is just one in a stream of setbacks. We can see, but on the left chart, that health insurers have generally had a fairly negative run since 2023. Moving to oil, we did see a 15% increase in oil over the past week. Some of that could be due to essentially the tensions and the geopolitical tensions, and maybe a lack of resolution in terms of some of that oil demand. But equally, oil does tick upwards when we have an indication of increased economic demand, economic growth, and that has been quite volatile in the past few weeks. Moving on to gold, and of course, I think it's important to always look at the US stock markets and gold side by side. If we first focusing on the stock markets first, there has been a drop in the NASDAQ. This has been, say, some more negativity in stock markets, but even now mentioning the rumors around the Fed chair appointment, some suggestion perhaps there will not be that monetary policy easing immediately. That is translated into a weaker stock market. But I think it's an interesting chart to compare if we measure the US stock market in gold. Of course, gold has had a stunning rise, and we'll show some charts later showing how it has been in excess of 5,000. But if we actually invert the two and measure the US stock market compared to gold, we know that at the time, moving from 2012 all the way through to this year, that there has been essentially no progress since the financial crisis if we were to measure it in gold, because gold has performed so well and the US stock market has performed well, but has not exceeded the supply of gold. And just staying on gold for a little bit, it's now broken the 5,500 an ounce, a record-breaking rally. We saw something similar in silver, but silver did give back much of that gains. And when it looks like where is this demand coming from, we've always suggested that central banks and China have been behind some of that demand. And it seems quite clear today, looking at the chart on the bottom left, that the Chinese investors' involvement in gold has really ticked up, and that speculative investment has generally led to this high rise in the price. Of course, we know from experience with Chinese retail demand that kind of speculative investment approach can lead to very swift sell-offs at the same time. So we don't know at this point the percentage of gold that is held in Chinese retail hands, but it is likely to be volatile if it is. Comparing gold to Bitcoin, we've done this for some time. Bitcoin was supposed to be the virtual gold or a digital gold. We know that Bitcoin did not perform this role over the course of 2025, not even close. While Bitcoin has had its own volatility, it has not had the same trajectory as gold, has not been seen as a hedge, not been seen as a diversifier. The dollar picture before just this week with the news around the Fed was a persistently weaker picture for the US dollar. We know that the winners in this currency match have been in EM currencies, which have surged to a 2-year high against the dollar. That will obviously be negative for them as exporters, but an indication of some of the confidence in those in those countries, and certainly a pickup, part of this overwhelmingly more positive picture for emerging markets that we've seen. And just looking in terms of the various crosses of the dollar is at a 4-year low. We know it's lost about 15% against the euro in the course of 1 year, and that this has been really a picture that is mixed in terms of its political gains. We know that President Trump has wanted a weaker dollar for some period, but equally, if it does reflect on a poor opinion of US fiscal policy or poor outlook for the country, that would be negative just in general for American assets. Staying on the East for a period, we know that the run-up in Japanese bonds has been historic. We've spoken before just last week about the earthquake in financial terms in Japan, whereby the bonds spiked upwards. That was supposedly a crisis in confidence in the potential economic outlook there, as well as concerns around the currency. The currency has been supported. And equally, this run on Japanese debt, which led yields to get to 3.5%. We spoke about the 40-year records being set there. This, we wondered, was a precursor, a canary in the coal mine for other concerns around levels of government debt. This is still sitting out there as a financial earthquake over the past week. Hasn't seemed to have affected markets this week particularly, but it is out there as a reminder of how quickly sentiment can turn. I've spoken before about silver and the 24 hours that we saw just over the early part of this week, silver notching its biggest advance in history and losing it all. Silver has definitely been accompanying gold along its gold rush, but it has always displayed far more volatility. And we've seen dramatic spikes, close to 20% in 1 day. And then for that to be erased, it just is another indication as to how silver could behave within the context of a portfolio. And that is it in terms of the prepared slides this week. I would like to reflect back, though, on the use of precious metals in a portfolio, because this is something that we had been asked about earlier in the week. And I think it's important to have a comment on that. So many investors think about whether precious metals should be owned in their real, actual physical form in a portfolio. In the US, they can be held in an IRA, a special precious metals IRA, as well as in the in Europe, they can also be held in a stocks or in an ETF in a regular IRA. Obviously, there are significant practical concerns when it comes to holding precious metals. We just think about storage costs, having a custodian. It is not particularly liquid. There are much friction between the ability to sell that. And equally, when we do have limits on an IRA in the US in terms of how much can be placed in one particular year, it's questionable how much actual metals can be purchased for that, particularly in the case of gold, when this is close to $5,500 an ounce. Could you buy 1 ounce of gold singularly and stick that in a retirement account? It doesn't seem like a very practical way to get exposure. I think I've left this chart up about silver's volatility because it is important to remember the characteristics of precious metals. They do not generate an income. They do not generate dividends. They are not easily liquidatable, as I mentioned before, and whereas they should be a store of value, they can be quite volatile. And we've seen this in terms of silver in the past week. And I also showed the dramatic spike in gold from Chinese holders. And we know that retail investors in China can also display quite volatile behavior when it comes to assets that are in fashion. So the potential for gold to be quite volatile is dramatic. And because of that, it is seen as a hedge. Certainly, it can be a hedge in the portfolio against a crisis of confidence in other more traditional risk assets. But as a hedge, we would only recommend that this hedge represent a percentage of the portfolio that is less than 5%. So a very small amount. So this is not something that can be ever predictable. Will there be an inflation hedge is the other question, in that traditionally precious metals and commodities in general have been a good inflation hedge. What we've shown is that over the past few years, there has not been a natural like-for-like inflation hedging characteristic. There has been a general good movement in line with mainstream inflation, but inflation shocks, generally, we have not seen commodities perform particularly well in the case of an inflation shock. Equities themselves do represent an inflation hedge. In fact, the only asset in a portfolio that does not guard against inflation is fixed income, and that would actually be more of a deflation hedge. So all of the characteristics of precious metals are somewhat there loosely, but they should all be read in the context of this being a highly volatile asset with many different stakeholders taking an interest. And it is important, therefore, to focus on the role that you're seeking this asset to perform in a portfolio. And if it is a hedging role, whether this could be achieved through a more diversified form, such as through an ETF or through some of the stocks that are levered to the precious metal. I will note, however, that many of those stocks have not performed like for like with the precious metal, but there has been some latency, some transmission effect, and they have later participated in that. So overall, our advice remains is stick with a portfolio that is broad-based and that is diversified, and that will give exposure to these sectors which we've spoken about, the techs, the grid tech, the healthcare, even if it includes the health insurers, which are currently having a difficult time, as well as some of the energy stocks mentioned, this, including green energy as well as traditional energy. A basket of a portfolio that holds all of these stocks, that is more likely to be resilient no matter what the policy environment. So I'll leave it there for this week. Thank you, everyone, and look forward to seeing you next week on the Markets Happy Hour podcast.